Welcome to Bloomberg Markets. I'm Katie Greifeld. We're covering the Trump trade and how that continues to play out in the market. So let's get a quick check on those markets right now. We start with the S&P 500, trying to decide what to do today. Of course, we had the best weekly performance of 2024 last week. You can see some of that momentum faltering a little bit today. The S&P 500 up about 0.1%. We're still above 6,000. We'll see how much that holds, especially when you have big tech actually slipping into the red right now. The NASDAQ 100 down by about 0.3% right now. Small caps are your winner and then some. The Russell 2000 currently higher by about 1.5%. Some of those more value-oriented sectors really getting a bid, and you've seen that most clearly in that index. And then Bitcoin. What do you do with Bitcoin right now except buy it? That seems to be the mantra in markets right now. Of course, Bitcoin above $84,000 a coin just today, up about 5.6%. So that's your broad macro snapshot. Let's get a look at some of the midday movers on the equity side. We'll do that with Abigail Doolittle.
Well, with that Bitcoin rally, Katie, not surprisingly, we have the crypto space really taking off. Take a look at Merrill Holdings, up more than 23%. And you can see Riot Platforms, Coinbase, and MicroStrategy all up 18% or more. Investors want in ahead of the Trump administration what the actual policy would be, could be, that will be pro-crypto, really buying the rumor, so to speak. It'll be interesting to see what the news will actually be. As for the healthcare space, this is also related to President-elect Trump. We will see that the shares of Cigna are trading higher. This is the shares of Humana are lower. Cigna up 7.7%. They made an announcement saying that the possible deal talk that had been happening between these two companies for a second time, well, it's off. They are going standalone. They have different criteria for M&A. They also want to focus on buying back their shares. It is worth noting Humana has a lot of that Medicare, Medicaid business. A Trump administration may be negative for it, so it seems as though that could be, according to some analysts, one reason why Cigna is stepping away to some degree. And then finally, I know this is your favorite today, Katie, maybe Monday.com, maybe more Matt Miller's favorite, right now down 16%, the worst day going back to 2022. The software company put up a very good third quarter, but relative to the guidance for this current quarter, just in line after being up more than 70% into today, somewhat priced to perfection. Investors feel they didn't get it. The stock down sharply, a Monday slump.
All right, the Monday.com with a case of the Mondays. Great stuff, Abigail Doolittle. And there's a lot of bullishness around equities right now, but the bears are still out there. Here are some recent guests on Bloomberg TV that have warned caution might be needed.
Markets seem to be very joyful right now. One would think the Trump administration would want to continue that type of environment. It's not surprising the markets are going ahead and running with the Trump trade, but I think there's a lot of information we have to dissect going forward to really see ultimately what does this mean.
It's as if every Trump trade's in a vacuum to itself, and they're all going to be winners. And I think that's a big mistake. The index is expensive. There's a lot of stocks out there that aren't as expensive. And I think that's why you really have to be selective and not get wrapped up chasing this euphoria that we've seen in the past week.
Joining us now with more on these markets, let's welcome in Ira Jersey from Bloomberg Intelligence on the rate side of things, and Aoifinn Devitt, Chief Investment Officer over at Moneta. And Aoifinn, I'll start with you because it's been almost a week, of course, since the election itself. We got a decision much quicker than I think a lot of people anticipated, and you're seeing the follow through in markets today. I mean, I'm surprised to see the Russell 2000 up another 1.5% today alone. How much more momentum is there when you think about the broad lift that we're seeing to risk assets?
It's really interesting. It is a slow process of digestion that we're seeing in terms of this election news last week. It didn't all happen in one day. I think there was maybe a little bit of trepidation around whether there would be any uncertainty around the results. It proved that there was not. Now we're seeing pretty strong promises made, promises kept kind of philosophy coming out of the Trump transition team and very strongly worded videos, etc. So it certainly seems like many of those policies are going to come into effect. And I think investors are starting to believe what they hear. And I'm not sure I agree with the previous guest who suggested it was all happening in a vacuum. I see these Trump trades as all being really tightly knitted together. And is it a zero-sum game? Not within the U.S. stock market. Yes, maybe relative to non-U.S. assets.
Let's quickly talk about that knitting together, because you're seeing tech kind of falter here, struggle, especially relative to its past several years of performance. At the same time, you're seeing healthcare, financials, for example, small caps really catch a bid. And it sounds like what you're saying, Aoifinn, is that this is all interconnected.
Yes, we have seen a broadening in market support for some time now. That didn't really move with any of the market news. We certainly know that in terms of the tax breaks coming and deregulation coming, that bodes very well for some of the other areas of the market, such as financials. They will not be impacted by tariffs. So that's also very positive for them. So I see that as very much a unified trade. As far as why is tech faltering, some of that's going to be technical factors, a bit of the run up, a bit of profit taking, maybe a shift into more digital currencies, more Bitcoin, digital assets. And equally, a little bit of uncertainty. The rhetoric is quite mixed in terms of breaking up some of the larger companies, and we don't really know where that's going to end up.
A lot of big questions there. Ira, I promise I'm going to come to you, because you think about the story in stock markets, it's been up and to the right. I can't say the same thing when it comes to 10-year yields. Of course, we got close to 4.5% on the 10-year Treasury yield last week. Now we're back to 4.30. Of course, the bond market is closed today. All of this volatility being expressed in the long end of the curve. How do you see this developing in the weeks and months ahead?
Yes, I think it does come down to actually what programs in terms of debt and deficits that a new Trump administration is going to progress. Because remember, back during his first term, he lowered taxes, and you didn't see any kind of spending cuts to offset those. So deficits increased every single year of his tenure. Obviously, I'm taking COVID out of that. I'm saying pre-COVID, because COVID was obviously a different story. So this time, there are some people who think that maybe the Trump administration and the Republicans holding Congress are actually going to cut spending, along with maybe doing some tax cuts and other things that they expect. But that's not completely obvious to me that they're going to do that. And I think that the market is still kind of on edge that there's going to be a strong deficits going forward. That said, Katie, look at last week's 30-year bond auction.
Right.
The best bond auction basically since 2013. And I think that suggests that there at least is some kind of optimism and demand for Treasury securities even after Donald Trump was elected president.
I think that's such a great point, Ira. And it was last week, I think I asked you, I don't know if this was on air or off, but where the bond vigilantes are. And you said, didn't they all retire? And I feel like these auctions that we're getting are good proof that there's still a lot of people out there who want to buy bonds right now.
Yeah, I think that's right. And at 4.5% to 5%, that winds up meeting a lot of yield benchmarks that some large institutional investors have. So there'll be at least some demand for 30-year and debt and longer when yields get up toward those kind of levels. Will that last forever? No. So there probably does need to be a cap on how much debt could actually be issued.
And Aoifinn, I'm curious to think about or hear how you're thinking about the bond market, because with all the gyrations that we've seen in the 10-year Treasury yield, et cetera, it doesn't seem like it's made any dent yet when it comes to this risk asset rally that we're seeing in the stock market. Do you think that it will at a certain point?
Right now, it's quite divorced from the equity market momentum. It's interesting. A lot more concern and worry is being in evidence on the fixed income side when we look at the volatility there. That's, again, been a pattern not only do we see around the world, but that we've noticed for the last 18 months. So what I'd say is it's making the bond investor a little bit more jittery, I'd say, in terms of that buy and hold strategy. We know that while cash yields still look attractive despite the recent drop in rates, is all going to be FOMO and compared to the equity market rallies, which are reaching new highs. So I'd say that we're not going to see investors hiding out in bonds just yet. They're still going to look for putting risk on. But again, based on that volatility, they need to have a strong stomach for it.
Absolutely. And you also make a great point that at least for right now, it doesn't seem like these two asset classes are necessarily talking to each other. But Ira, I was having a conversation with Bob Michael over from JP Morgan last week. He said that 5% could be a level on the 10-year Treasury where you start to see some pain. Some other big shops have echoed that sentiment. Walk us through the game plan that would take us to 5% on the 10-year Treasury yield, because it looked like we were sort of building the momentum to get there, maybe calming a little bit down now.
Well, I think there's a Well, it would have to, I think, initially come from economic fundamentals being even stronger than what we've seen so far. So if you wind up with a couple of prints of higher non-farm payroll numbers, as well as spending continuing to be pretty robust, and again, any policies out of the Trump administration that might be viewed as inflationary, all of those things might increase Treasury yields pretty substantially. What you haven't seen, though, Katie, out of this is things like if swaps on CPI and also break-evens on Treasury inflation-protected securities. So the market's view of inflation expectations, those have only gone up a couple of 10 basis points. So that has not been the driver of all of this. It's really been it's been real yields, which implies to me that you're really looking at Fed policy and supply as the two main drivers and factors that are driving this. And again, that can only go so far without an uptick in inflation or inflation expectations. So I suspect right now we're probably at an equilibrium, finding a range. To break out of that range and above 4.5%, heading to 5%, you probably have to wait until the first quarter of next year.
All right, Ira, Aoifinn, great stuff. Really appreciate you guys taking the time. That is Ira Jersey with Bloomberg Intelligence and Aoifinn Devitt. She is Chief Investment Officer over at Moneta. Now, coming up, we'll turn to digital assets. A huge rally underway in Bitcoin, of course, seeing massive gains in valuation as well. How much momentum does this trade have behind it as we approach a full week since the U.S. presidential election? This is Bloomberg. Welcome back to Bloomberg Markets. I'm Katie Greifeld. It's time now for the stock of the hour, and we have several stocks today, and they're all crypto flavored. You can see Coinbase, Marathon, MicroStrategy all soaring today as Bitcoin hovers close to $85,000. Now, of course, this increased optimism comes ever since Donald Trump won the election last week, with investors anticipating more acceptance of crypto in the White House. For more on this, we are joined by Bloomberg's Mike Regan. He leads crypto coverage for Bloomberg News. So increased acceptance. I mean, crypto had a great election.
Yeah, absolutely. And, acceptance might even be too weak of a word.
Embrace?
Embrace. I mean,
bear hug?
I think if you go back to Trump's speech at the Bitcoin conference in Nashville in July, that's when he said he wants to create a strategic stockpile of Bitcoin. Now, what does that mean? It would kind of be like the strategic petroleum reserve, except instead of oil, you'd be holding Bitcoin. Now, what's interesting about that is the day before Trump spoke, RFK Jr. came out and spoke, and he said, I understand Trump is going to announce plans to buy 1 million Bitcoin.
Now,
we're talking about $85 billion worth of Bitcoin at these prices. Now, Trump never actually made that promise in his speech. He did say he wants to create a stockpile. It will start with Bitcoin that's been seized by the government already. But then Cynthia Lummis, the senator from Wyoming, came after him with a bill to do just that, buy 1 million Bitcoin for this reserve. So I think, there's sort of a deliverable there from Trump. Is that a plan that he's really going to push? Mm-hmm. To really have the government spend at today's prices 85, 90 billion in Bitcoin. And that, I think, is what is the main driver of the optimism from Trump. Now, there's plenty of other sort of Trump-adjacent themes that could make people bullish on crypto. Right. Just the risk-on nature of the markets. If there's tax cuts coming, he promised to hire, regulators who are real fans of crypto, not the sort of adversaries that they had in the prior administration. So there are other reasons to be bullish from Bitcoin. But I think, to me, that is the big question mark, is will Trump really, go so far as to suggest that the U.S. should buy 1 million Bitcoin for this reserve? And it seems like the market is pricing in a pretty good chance that will happen, because if you look, obviously we would need congressional approval, but if you look at the last election, this Fair Shake PAC was so successful with their spending.
Well, that's where I wanted to go. What needs to happen to make a Bitcoin reserve a reality? Congressional approval. The crypto community has a lot of people who love crypto in Congress now.
That's it. And the sort of the moral of the last election was it's just pretty risky for a politician right now to be anti-crypto.
Right.
You know, industry was the biggest corporate spender on the congressional campaign, something like $130 million. And, you know, their win-loss record, I'd have to go and look it up exactly after the election, but it was pretty good. You know, the candidates that fair shake, the PAC backed, tended to win, I think, almost all their elections. So, you know, money talks in D.C. It's at one point, I think it would have been really sort of far-fetched to imagine the government creating a strategic Bitcoin reserve. But if it's something Trump wants, and it's, you know, it seems like something that is at least theoretically feasible within the Congress right now. I mean, I think Trump has a long list of priorities. Where that one falls and the timing of it could maybe, you know, people start questioning that going into 2025. But for now, it's really hard to find anyone who's bearish on Bitcoin at all because of these tailwinds.
And as such, I mean, you head up crypto coverage for Bloomberg News. I have to imagine your team super busy right now. Now that we're through the election, we know the result, we pretty much know the makeup of Congress. What's top of mind on the desk?
I think that reserve, you know, seeing if there's any more announcements on that, if that bill really stands a chance in Congress, then, you know, who is the SEC chair going to be? Can Trump really force out Gary Gensler if he wants and put in a real crypto-friendly SEC chair? It's a big open question, so that's something we're curious to find out.
A big open question, the fate of Gary Gensler. Mike Regan, it is great to see you. That, of course, is Bloomberg's Mike Regan. He is team leader for crypto coverage over at Bloomberg News. Now, coming up, crypto is just one part of Trump's proposed policies. Next, we're looking at how companies are bracing for a new era of Trump tariffs. National Retail Federation President and CEO Matthew Shay joins us next. This is Bloomberg. This is Bloomberg Markets. I'm Katie Greifeld, and there's a lot of concern over what possible Trump tariffs could mean for the U.S. economy. Here's what guests on Bloomberg have had to say just this morning.
Tariffs will be on very quickly, I'm expecting.
What's going to be market negative if Trump comes out and he does institute right away these tariffs and he's very aggressive about it?
I hope he walks away from across-the-board tariffs.
If anything was a referendum this election cycle, is that Americans are supportive of Trump's agenda on tariffs.
If we do get tariffs to the extent that the administration is talking about, 10 to 20% and, upwards of 60% for China, and we do get some of that immediate retaliation, I think we do wind up with stagflation.
I think the market's taking Trump at his word that he's going to try to do something. Again, if we have a massive tariff structure, it's going to hurt parts of the economy.
There is a reason that a number of business executives called to congratulate Trump right after, because they have a very, very vested interest in trying to reduce the number of proposed tariffs.
Joining us now with more, I'm pleased to say we have Matthew Shay. He is president and CEO of the National Retail Federation. It's great to have you with us. Your research has found that American consumers could lose between $46 and $78 billion if these new tariffs on imports to the U.S. are implemented. And just set the scene for us. What industries would be hit hardest potentially?
Well, Katie, it's nice to be with you. The study that you referenced is one that we released just last week, and it was a very limited study. It looked at 6 categories of goods that you would find in virtually every household in America, footwear and apparel and household appliances and a number of others, just to give a sense of what would happen even on that limited set of imported goods. And the findings were very, very dramatic, as you would expect, because we import many of those from countries outside the United States. And our estimates were that these prices would increase sufficiently that customers would lose up to $80 billion of annual spending power. There have been other studies out there that this would cost between $2,500 and as much as $7,000 per household per year. So very, very significant consequences if the president-elect goes through with the kinds of things he said about increasing a mandatory tariff on all imported goods 10%, raising imported goods on China tariffs as much as 60%.
Right.
So really dramatic consequences for American households.
And you think about the CEOs of a lot of these companies, a lot of them were around in 2016, in 2018. Is there a roadmap that some of these affected industries, the C-suite, has for this potential tariff wave?
Yeah, Katie, I think one thing we have to remember is that this is a dynamic environment already, and it's been a very dynamic environment for the last decade. So as the economy in China has evolved over the last 15 to 25 years, their consumers have moved into the middle class, labor costs have increased. Retailers and other importers were already working dramatically to move their supply chains out of China because of increased labor costs and find other markets to produce those goods for import into other countries like the U.S. So retailers and other importers have not been standing still. That was a process ongoing even before the 2018 round of tariffs imposed by the last Trump administration. The Biden administration not only didn't reduce any of those tariffs in the last 4 years, they increased tariffs on almost 20 categories of goods. So this is something we're all dealing with. You add in the pandemic, supply chain, inflation, very dynamic environment. Retailers are always looking for ways to diversify their supply chain and bring better value to customers.
Matthew, I have less than a minute left with you here, but I'm curious about what recent history tells us about how these tariffs typically trickle through to the U.S. consumer. You think about importers paying these higher prices. Do they typically pass them on?
Absolutely. I mean, a tariff is a tax on the importer, which get passed on to the end users, the consumers, or the price of the input good that's being produced here in the United States. So we know in this environment with high inflation, with consumers focused on value and price, retailers and others won't have any choice but to pass on those cost increases and raise prices. That's going to be inflationary. It's going to be regressive. It's going to hurt families making under $50,000 a year. It'll make us less competitive, and it'll slow our economy's growth.
All right, Matthew, hope to have you back again soon. Really interesting research and perspective that you bring. That is Matthew Shay. He is the CEO of the National Retail Association. Meanwhile, that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.